In 1997, a Charlie Rose interview that Peter Lynch did, and I do have to say, apologies. Some of the cute in this interview are going to be quite abrasive because I don't understand. Like Charlie Rose, he just interrupt Peter all the time in this interview. So I apologize. I have tried to do the best I can get the meat of the agreement because I think the whole interview is about 25 minutes, so I have tried to top it down into the best bit so that said he gets stuck into glad to be here had explained to me what going on. While we had a huge run, I mean the market was 4,000 just 2.5 years ago, yeah, and it ran up to 830 in August, and you know, like any big rally sometimes it break off. I mean, it's healthy, everything is a offer pieces, yeah, and that does help anytime the market scenes worldwide to see show between 10 time earning and 10 time earning. If you look at the Dow Jones the spare 500, if you add up all the companies and take the earnings, you say there is relationship and it follow. McDonald earning have been tripled the last 13 years and the stock been direct relationship, so the earning of the 500 have been between the range of 10 and 20. We have just about to go over the 20, which is the high end of the fee range, where is not a lot of fee. 20 is 2 is it is the top of how high it should ever he right. It been about there are only a few times over 20, and it when its inflation about zero. So this clip kind of just sets the scene because what Peter Lynch is describing in this clip is actually what we see today. He talking about how the pressure of the market generally sit between 10 and 20, with 20 really being that upper end. Well, now those days we have discovered what the ultra upper and in the that number looks like, and it's said to be about 13. Now that's kind of scenario because what we currently see is a fashion for the market at 35, and it is only been over 30 in 3 time in history: 1929, 1999, and right now. So there are no question that the market is certainly hot, just like the market was hot back when Peter Lynch did this interview back in 1997. But the question we have got to ask ourselves is oil. How do we go about our investing in this environment that declined yesterday? In a sense, it led up some of the involution. The market was even overloaded at where it was right, and by letting it up like then we got back to what reasonable, well, I should say fairly prices made of the largest company. They are now okay. There might be some small companies. We have had 300 companies come public the last 4 years that two of business day. Some of those companies have gone down democracy, and had some of the research on that average people in the stock shop that we can find. Some people know at loss about this 10,000 people company. A lot of them are very attractive, no one following them, and there are lots of people following IBM. What you have got following companies that nobody else is following, right? I like to get a company with a union, or companies in trouble of, or companies that no one likes, hotel that have nice bed. Well, yeah, and you have to look a lot of them. You look Pedro House, your white road, that the story. Okay, you got fewer one import. My wife found that one too, but you have to look at 20 to find one. It's just go to the mail and find the stock. I mean, you have to say, my god, this sound like it could. Then you have to do some step, you have to do an organized method. Now the method will get the in a second part in this clip. Peter inevitably describe inexactly how we should be approaching our investing right now, because today, even though the market is really high, we are in an environment where actually a lot of business are going down. And what we see in the that an index like the SP 500 is actually propped up by literally 5 or to 10 really high performing massive behemoth companies. Now what Peter telling us in this clip is to be a great investor even when the market really overvalued. You have to get away from looking at just those massive behemoth companies, everybody following those big companies, everyone investing in them of this price for those big companies are sky high. So we should be broadening our horizons and looking maybe at a company that come after the 15 largest stock in the SP 500, or maybe beyond the 20th largest stock in the SX 200, because that where you are more likely going to find value. And then the other secret is that, of course, you just have to keeping looking at a lot of business. The best investors are the ones that turn out the most honest, right? As Peter Lynch said in this interview, you have a lot of 22 fine on all right with the side. Now let's have a look at the actual step that we should have be talking to go ahead and make an investment in this sort of environment. Then you have to do some step, you have to do an organized method. People are carefully when they buy a toaster, carefully they do some research, but they don't do it with stock. They call it the broken. They see somebody at launch and they said, man, I got this hot stock, and you run right out and you spend $5,000. Small investor, or even maybe they put on option in international data, who is they don't even on international, and it's like a download. So I like a casino, you get the some result, and if there is more paperwork, right? So this morning you get up and you go in, you look at those companies that fit that you know something about. You have a to have an let's say the cement industry goes from creamy to semi-creamy to file good. His stock are going north. You are going to make money that the industry, you know, when if you know the publishing industry, some people have an your work. I mean, one of your last 13 years you work in this restaurant, you must have seen Taco Bell, you should have seen somewhere, you would have seen pizza, or what you have seen chill, you have seen those companies doing well, very well. You should have brought those instead of trying to buy technology stuff you know nothing about. I mean, I know nothing about local area networking. A lot of people are buying this Cisco, they are buying the equipment, saying you have going to road together all this very helps and it together the servant, but that not a bit by, because they own a huge percentage of the market. You know what that was, they are saying only a few people had that. My god, if it work for us, the other people try it, them college will try to high school will try, they will go overseas. They know they were early in the bell game and they should have been buying the company instead of out to buy something they don't know everything about, some oil drilling company. I mean, people have this tendency to always buy something they do not all of need to a futurely. All you need is a few good stock. This in your song, this have been your song for a long time, but only buy what you know now. But people wake up in the morning and say there are 5,000 companies out there who is on should I buy. The average person brought out the able to follow 4 or 5 companies, though should be a lecture on them. They understand the company and this force you this told say to you write down the state, but you keep anything this so that makes sense. You have to start with obviously going ahead and doing some research. He said people do a lot of research when they got to buy a toaster. Why is not there people a lot of research when they go to buy a stock? Don't treat the stock market like a casino, and then when you actually do it down to learn about some companies, look at the companies that are really relevant to you. Warren Buffett should use first step within your cycle of competitions. Peter Lynch example here is, if you are someone that works in the restaurant industry, look at Pizza Hut, look at Taco Bell. They're companies that you probably already understand to quite a high level and do cut massive around with this by technology companies that nobody understood. So once you find those companies that resonate with you and you go in the research as a Peter Lynch, say you only need 4 to 5 good stock in a like a Dickon Warren Buffett. You need even less than that, but you should know those companies well enough to be able to give a lecture on their business. So that really the first step is to stay within your kind of cycle of competition. A second step, go in and understand those business in depth, and thereafter that what happens next. Well, let's listen in one things you are trying to do all those public companies on their here the companies I really like. The fundamentals are terrorism, they are earning, are doing well. The competitors are doing poorly. I think this company is doing terrorism, and lot of a sudden the stock might have gone from 14 to 30 because of this tagline that we should say, wow, here is a chance to buy it. So you are trying to say some companies might have been overprices at 16 and all they did was go to 15 and say big deal. So you are trying to find company you like, and you are right now you like them, and now they are had a haircut, or that what you should do. You are not just like the one from overpriced to fairly prices. Something was fairly prices at the start of this exercise, and then had a very a fair 5 for sale. If you had the managing the migrating fund in this morning, you should have been buying like crazy. I should have been researching like crazy. I have been saying which companies are the same story. Is there anytime really happening? This is a non-event for them. They are still doing well. Even if I have a researching, there are nothing to do with them, and that's the kind of I am trying to buy. But let's say if a company just think of these are being, you say yourself, I think this company is gone on something in the future. It is already discounting that it is selling at a huge multiple. You say it's already it had the work and it going to stay even. So you have to say yourself, if I am right, how much I am going to make. If I am wrong, how much I am going to lose. That the risk reward ratio in stock stop we talk about. I am right. I hope I am going to double trip my money. If I am wrong, may I lost 13-14% that a favorite ratio. You say if I am right, the stock not going to do up or already discounting horizon thing is discounting horizon thing are already in the stock. I do not know. Okay, so first step is to find a company where you have got the in. The second step is to really understand the business, understand the financial, understand the fundamental. But then what Peter learns talk about in this environment where basically everything verbal. What you want to do is you want to try and find companies that are just fairly valuable even in this team valuation environment, because as investor what we do, we buy undervalued stock, right? We always buy at a discount to treasure value. At this how we know we make money in this long run. And if you find a company that really get, but it's also really expensive in this environment, and then there's some sort of 115 market dip, and it bring the stock back down to fair value. While them remember you are still, it is still like paying full retail for that stock. So what we are looking for is great businessmen that in this our valued environment are just fairly valued. So if anything does happen suddenly in the market, sometimes cause a 10% dip or a 15 dip, then all of the sudden that business goes from being a fair value to no being undervalued. So they are the kind of situation we are looking for. Imaging this, that new Xbox and X console full retail price I think is 715 Australian dollar. You have went into say games and they were selling that Xbox for that is was $1,000, and now it dropped down to 715. You are not getting excited by that deal because it just come back down to full price, but that same store was offering it started at 715 full retail and then it dropped it down to 500. Well, obviously that are much better deal. Exactly the same thing with businessmen in the stock market. And just quickly the other thing to note from what Peter Lynch said in this little clip was when he said if a stock is trading at a huge multiple, it basically has to work right, and it does work for them. You are still just even today what we are seeing in some companies, they might be great companies, but they are trading at valuation in 100 if not literally the 1,000. Like some companies for instance like Tesla, I think has a ratio of 113k. Now what this mean? It is means that the price the investor are paying today, this is already they are expressing for a continuous growth for years and years to come. That what the share price is telling us. Now if you are investing in a company like this at this prices, then there are very little room for upside and there are a whole lot of room for downside, because investors right now are already expensive year and years of prospection, right, of absolutely perfect execution. As Lynch saying, you have to factor in right now how much I am going to make and I am wrong, how much and I am going to lose, and that this very important couple of questions to ask yourself before buying into a stock. And that where you go back to your discounting cash flow analysis and you look at the growth ratio to figure out what the risk ratio is for the company that you are looking at. What we are saying to people today about the future of the market over the near term is what you are feeling. We can have to buy business and fleet it, and have to no idea what the next 1,000 point going to be. The next 6,000 point can be up, the next 14,000 point will be next, 20,000 point will be next, but we know where the next 1,000 is gonna be down, could up, nobody does, and it's put till too high, and goes it corporate profit will be a lot higher 10 years from now, it will be a lot higher 20 years from now. That what you should rely on. The third step that Peter Lynch highlights in this clip is to always focus on the long term to be aware about what the market will be next week, next month, or even next year. What you should be really focus on is that what in this company going will look like in 5 years from now, in 2010s from now always focus on the long term, because if you can do that, then short term market inflation they really on matter on you, just don't steam about them at all. In fact, when prices go down you get excited, you don't get a scrap. As Peter Lynch say, corporate profit will be a lot higher in 10 years from now. They will be a lot higher in 20 years from now, and that what you have to really on. So we really on the fact that yes, businessmen are going to continuously prove, not maybe not even the next year or two, maybe there's something like what so the lockdown where business is impaired for a like whole years or two, it still does not matter to us, because we look for situation where what going to be happen over 5 years, so what going to happen over 10 years. And if the situation is favorable, that when we invest that about all the curriculum of deviation and the impact they have had, that the little complicated from me. All I know is, I do not know about if for you it is all over my head. I have never brought an option in my life. I never brought your time on your side when you are on stock. I don't know about putting 3% down and buying a future in a stock and a saddle that are very hard can do that, right? Somebody else deal with it, all right. So you are optimization or optimistic about the future of the American economics. Earning potential for most well-run companies will do all right, but people have to understand we have the 9 reasons since World War II. We will have other reasons, but we are not in one now, but we may have on this future and do not care, or it will have on something it is happen and no will to tell you when it's going to happen. It's on the fundamental tell you the you will find out after the fact. You will all of a suddenly you will notice orders slowing, prices get more competition, then earning are down. Actually you find that effect no one declare, everybody saying we are going to have this kind of 5 years. It just was happen. It is a great to see you. I hope you have come back anytime, Peter. I really like this last clip from Peter Lynch. Just a lesson. You do not have to get to fancy right, you do not have to drive into things that you do not understand, like a lot of stock investor. They are just all offer option. Peter Lynch is the first of put hit hand up and say I love investing in companies. I do not have a close word going on when it come to option, never brought up an option in my life. So step one, find the business we are no new understand. Steps two, make sure that you can make sure you are looking at value businesses that can go undervalued. Step 3, focus of the on the long run field solid business with low debit, high cash flow, and just keep focused on that stuff, because that the winning formula. We are going to see recession in the future. We have seen a recession in the past. It could happen tomorrow, it could happen next week, it could happen in a year time or 5 years from now. But the main thing is the strong companies with solid cash flow that you are understand that you are going to hold or for a long period of this. They are the ones that are going to make it thought, and they are the ones we should be ultra focused on it any stock market environment. So anyway, guys, I hope that you enjoyed this video. Always like telling to what Peter Lynch have to say even in those really old interviews like this in from 1997, and yet just because market was high then market right now, everything that he's saying is almost directly applicable into what we are doing with our investing today. I love it, and when we can draw those kind of parallel, it's like poetry. But anyone guys, hope you enjoyed this video. Leave a like on it if you did, subscribe to the channel if are not done so already, and make sure you check out for full likes down in the description below if you like to learn about I go about my investing. If you are like to learn about, a lot of key point in fetal licon strategy in much more details and kind of like step by step, then feel free to check out the to stock analysis. But that will do me for today guys. Thank you guys very much for watching, and I will see you the next video.